Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us there were big shifts in the AI group and that crude may be setting up for a correction. Uranium is positively glowing, which is good for junior miners in that sector. Ross also has a special offer for our listeners. Publisher of Rick's Picks, Rick Ackerman, answers our questions about the U.S. dollar, gold, the possibility of recession, and oil. He also says a new low may be coming for American commercial real estate. InsideTrackTrading.com President Eric Hadik examines the cycles surrounding the stock markets, crude, the U.S. dollar, interest rates, and gold. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show.
Good to be with you, Jim.
Ross, how would you describe what happened on the stock markets this week?
Choppy, with a big capital C at the beginning of it. I mean, this is a week where we ended up within 1% plus or minus as far as the broad indices were concerned, but a real chop in the middle of it all. Pretty good as of Thursday. It gave everything back on Friday. We're just, we're into this phase here in September where seasonally we could see a little bit of pressure, in particular the second half of September as you move into the end of the month. Might be looking for a pretty good low, and that's in the meantime it's something for the short-term traders to tear their hair out, because they'll be right today and wrong tomorrow on their decisions. So if you've got a long-term view perspective, you just sit back and wait for some good opportunities. And, we've had some, big shifts in here. If you take a look at the AI group, in terms of the price action there, we've really seen this thing top out, back in June, double topping in the summer on some of these things, and continuing to ease down. If you take a look at the big names in there, the Apples, the Microsofts, NVIDIA, you're down anywhere from 2 to 5% on this week, and they've had their big run. And we're going through our rotation. You've got the healthcare stocks, the healthcare ETF, the staples, consumer staples, holding in very, very well in here. So the defensive group is where people are, and that's where the opportunities, at least the conservative opportunities, are.
Crude made headlines this week. Can you tell us why?
Oh, we've got $90 crude oil, and this is pretty significant. Our work, we've been watching the commitment of traders numbers, and the levels that we're seeing here are such that we haven't seen since 2019, where the commercial positions are becoming quite short, and the speculative long positions, the net position there, very long, and it's putting the technical indicators that we look at, the Bollinger Bands and the Relative Strength Index, to extreme levels that, if I look back here, what have we got? 1, 2, 3, 4, 5, 6, 7. I got 8 examples since 2012 where we've had levels such as this and had pretty good downside corrections. So this vertical move that we've seen in the oil market in this last few weeks is on. Regardless of the COT numbers, we are seeing just classic overbought levels as far as the energy complex is concerned. So look for a correction, and we've got some work that we've done updating the 10-year cycle that we watch in crude oil. We've discovered the action on this cycle a number of years ago. And as it goes through phases in the 10-year cycle, you'll look for a specific type of action. And this move that we're into right now is very, very typical of what you would expect to see at this point in the cycle. We've got some pretty good indication of what to look forward to here in the next maybe 6 to 12 months. So we'll be looking for some good trading opportunities as we move through the winter.
What's going on with the U.S. and Canadian dollars?
U.S. dollar has had, this exceptional move up off the low. We've gone to the point we're up at 105 on the index, pretty much a flat week there. And the various currencies like the British pound and the Japanese yen have been giving up ground. But the Canadian dollar had been oversold, and it's bouncing back. The action there, we've got, oversold a week ago, a bit of a bounce in here. So with us trading now just shy of 74, you're probably looking at anything in the 74.5 range as significant overhead resistance.
Anything happening with gold?
Yes. We've been looking for the gold market to put in an important low here. The optimum was going to be that we would sell off into this time frame that we're in now, put in what we would call a cyclic low, and ideally on Friday we ended up with the sequential nines in both the silver and the gold market. That's 9 consecutive days with closes below 4 days earlier, and when you get those two happening in both commodities at the same time, the probability of a decent rally sits in place. So you're going to be looking for probably a good rally out of here. And the key is going to be, once again, that summer high that we put in, just over $2,000 in terms of the December futures contract. And as far as the spot price, you're looking at something around the 1980 level. If it takes those price levels out, then that sets this long-term consolidation since 2020 with triple top, sets it to the point where we could see a big breakout. So we're going to watch this rally off the lows pretty carefully. It's in a bullish mode right now, and it's doing it without the weakness in the U.S. dollar. The dollar's been holding well, and for gold to be managing to hold the gains that it has made off the August low is very, very good.
What do we have in the anything else file?
Well, the anything else is these uraniums. The world has come to life in terms of realizing that if they want to have a green agenda, they're going to have get back to having more nuclear facilities. And if we take a look at the action, the Cameco, which has been, the strongest stock, and on a relative basis for the last 5 years, it is now up into target levels. We had a $42 measured target out of the consolidation of the last year, this triangle that it's been trading within. So the breakout at 30 Had some nice calculations, 42 being the target. And as of Friday, we've got what we call a trifecta sell. That would be overbought conditions in the daily, weekly, and monthly charts. And, we're seeing all the juniors just have come to life here big time. If you take a look at any of the stocks within that complex, on the week they were up somewhere between 6 and 15%. So while there's not much happening in the overall markets, clearly the uraniums have been providing some fireworks out there. The overbought right now, probably due for a pretty good correction, and that will become a new buying opportunity. Take a look for some decent short-term oversold conditions to get on board if you're not already there. This thing looks as though it's got legs that will be here for quite a while.
Ross, thanks for that glowing report on uranium.
Yep, and we still going to offer 25% off for new annual subscriptions. We're doing that as sort of a promotion for this month because there are opportunities that come up during the September-October timeframe. We want to make sure that people have the opportunity to come on board.
Ross, thank you so much for being on This Week in Money.
You're welcome, Jeff.
My guest has been Ross Clark from chartsandmarkets.com. You'll find him on Twitter at Charts by Ross. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website RickAckerman.com. Today, he is speaking to us from
Charleston, South Carolina.
A city so nice they named a song after it.
Okay, thanks as always for inviting me on, Jim. It's a pleasure.
And it's a special holiday for some people.
We begin the Rosh Hashanah Jewish New Year tonight at sunset, and that's one of the reasons I'm here. Just celebrating the New Year with a friend. And it's a 10-day period, culminating in the Day of Atonement, which is next Sunday evening and Monday.
Rick, is the strength of the U.S. dollar surprising?
Not to me, it's not, and certainly not to anybody who's been listening to our interviews over the last 5 or 10 years. I don't want to state the obvious, but when everybody gets on the same side of a trade, you know that they're going to be problems, and certainly everybody has piled on to the dollar bandwagon, the short dollar bandwagon. We've got people who think we're going to inflate till the end of time, and that means the dollar is going to hell. We've got the crowd out there that says the BRICS, Brazil, Russia, Iran, China are going to substitute their own form of currency. We've got the crowd that thinks that the central bank's going to implement a digital. So everything's been running so hard against the dollar that I don't think not many people have noticed looking at the chart that it's just been going up, and of course nobody in this world wants a strong dollar because it increases the burden on all debtors who owe dollars. So they have to pay back in more expensive dollars, and that's exactly what's happening. And to the extent that some financial entities are being squeezed already to pay back in dollars, you have something of a short squeeze, short covering in the dollar. So, and that's, to me, is what's going to really drive the big push in a dollar higher and higher and higher, is a squeeze on debtors who can't roll over short-term loans. That will be the precipitous part of our dollar, of the dollar's takeoff. And I say that as if on a fundamental level, I hate the dollar. It doesn't really qualify as anybody's kind of good money because, as we know, it's really just an IOU. There's nothing backing the dollar, and I'll concede that it's fundamentally worthless, but it's got a lot of history and tradition and even something of a mystique. So that's why it's going to more than survive.
Do you think the BRICS will come up with a gold-backed currency? There were rumors they were going to do that back in August.
Well, I would say why. No one wants to deal with the obvious questions. Like let's take Switzerland as an example of a country that had a currency that was almost as good as gold, and they decided wisely some years ago that they were going to have to trash the Swiss franc lest the whole world bid the price up so that Switzerland could no longer export some of those precision machines and things that they were famous for. So with Switzerland, it was a choice of we either let the Swiss franc fall or the economy fails. So if you put that in the current context, why nobody wants a strong dollar? Countries that produce energy, your net exporters of natural gas and petroleum, do they want to price what they're selling in gold? No, because nobody could afford it. The only reason the world can keep on paying for energy is because they get to do it in global snide, meaning that the dollars are an infinite supply, and it's convenient for everyone to pay their bills with dollars that are always there. So the BRICS, nobody wants a hard dollar, and even the Chinese, they'd be in much worse shape right now if they put a hard, they peg the yuan to something worth intrinsically something. So, you can just forget about this idea about a switch to a hard currency. And the even more obvious point that I keep making is, how do you, we've got a global market in leveraged securities, we'll call it the derivatives market, and the notional value of it adds up to something higher than $2 quadrillion. So, since the global GDP is only maybe 1/6 of that or so, it's correct to say that the business of planet Earth is shuffling paper, is just creating leveraged financial instruments. Who the heck wants to get their hands dirty actually making things, manufacturing? So the primary business of planet Earth is just shuffling paper. And so how do you take whatever currency supposedly we're going to implement to replace the dollar? How do you replace those $2 quadrillion that essentially support this shaky edifice of the derivatives market? So that's one more reason we're not having any alternatives to the dollar. The dollar is the only currency that can handle a shell game that large.
There's talk of going to digital currencies around the planet, maybe just one digital currency. Do you think that's going to happen?
Well, I think I just answered that question. But the digital, we have a digital currency. It's called credit cards. And, the credit cards are just as digital as anything you can think of, really. There's this huge market of literally trillions of transactions that take place in the credit card market. But what do you think they settle against? I mean, what is that market? And it's really just a lot of digital transferring of not money, but of pluses and minuses that in some ways tie to the money markets and other very liquid sources of cash. So no, we're not going to have a digital currency.
And if people think that will stop people from having some kind of currency, apparently the mob is using Pokemon tokens as a way to move wealth around, because you have to report cash, but you don't have to report Pokemon transfers of tokens around the planet, so they can send millions of dollars of these tokens around. So again, they get around currency restrictions.
Well, you got to watch out though. My kids collected Pokemon cards, and they don't exactly they don't have a stable valuation.
No.
And it turns out, if you want to collect something that no one thought was worth collecting, like Oldsmobiles or something like that, But Pokemon was sort of dreamed up as a collectible, and that's why it failed. But so many people dumped their collections that the few of them, it hung around for kind of a revival. But I wish the mob well, really, trading Pokemon. They might take an example from the Indians and trade wampum, because it's probably better.
Yeah. Gold remains in a trading range. Gold stocks continue to be out of favor. What do you see there?
Gold is in a bull market holding pattern for years. And I think it's just waiting for a major tone change in the financial system of planet Earth. So it's kind of marking time. Today, it's in a pretty good rally. COMEX Gold's up about $16. And I have to remind my subscribers that it's a fake like every other rally, and that the sell signal will come when the rally has gone far enough to give you some mild encouragement. So that's how gold trades, and it's in no hurry. It could blast off tomorrow if the underlying conditions change. If let's say a bear market in stocks gets going, but I think that's initially going to bring gold prices down anyway. Certainly gold stock prices. So I wouldn't get too excited about gold right now. It's in a bull market, but it's not going anywhere.
Is the U.S. in or headed for a recession?
We're in one, and Apple was your sort of mine canary there. They hit it so hard last week that it was unmistakable. All the usual experts were talking about, well, how could this have happened? And they looked at some of the products and this and that, and of course Apple has come up with the huge innovation with the release of this latest iPhone, and that is that they're using a C-type charger. That's a big thing for Apple, and even though Europe forced that change on them, Apple is celebrating it, promoting it like it's some sort of technological breakthrough. So anyway, yeah, Apple was down, and the usual numbnuts were speculating as to why, but it's very simply because Apple knows a recession is coming, and probably no consumer product on this planet is in jeopardy as much as the exorbitantly overpriced hardware that Apple sells, primarily its phones. So if you just lengthen the replacement cycle, as will occur in a recession, instead of people replacing their iPhones every 2 years, they might sort of switch to 5 years, no matter how spectacular the changes are in the iPhone. And by that I mean they would add 3 or 4, 5, 10, 20, 50 new features to the 500 useless features that are already included with the iPhone camera. So they'll make improvements to the camera, but it's not going to drive the replacement cycle to the extent that we'll have people replacing their iPhones every 2 years.
And of course, iPhone might have more of a problem here. France is cracking down on iPhone 12s because apparently they send out way too much radiation. You're microwaving your brain every time you use one.
Bless the French. You could always depend on them to take a shot at. They think Apple's an American company. I guess that's why they've gone after them.
Well, there, you can use your Apple to fry your egg or your oof.
That's right. Well, I don't know. We still, the electromagnetic radiation, the spectrum argument has been going on for so long, and we still haven't resolved it. And of course, it makes it that much more mysterious when you talk about the very small amounts of electromagnetic field you're subjected to when you hold an iPhone to your ear. So who knows? I think we really have cooked our brains in some way, and the best evidence of that is the way we run our political system here in the U.S.
Is crude oil looking bullish as we head into the fall?
looking bullish today, that's for sure. I've always told you I just don't understand crude. I really don't. It's currently being driven by the least credible of all factors, and that is an artificial curtailment of supply by the Russians, I guess, and who knows, Venezuela, Iran. So to me, a real bull market in crude is necessarily driven by increased demand, like a global resurgence in manufacturing or whatever, with China sort of leading the way. But that's not happening at all. So I would say that the crude, which is since March, early April, it's rallied from $64 or so up to, we're currently trading 90 on the NYMEX crude, and there's no fundamental basis for it really, and I just don't think that this curtailment of supply can drive it much higher. But having said that, I'm using a target for crude at $99.84. That's basis the October NYMEX contract. Crude is currently hesitating almost exactly at something I call a secondary pivot. But if it closes above it, let's call it 91 to round it by a penny. If it closes above that for a couple of days, I think that this October crude's going to go to 99.84. I would short the hell out of it at that price just for a trade, because it's definitely going to pause there. But this could, right where we are today, could be at least a temporary top for crude. So anyway, that's the way it looks technically.
Could the manipulation of energy prices be used as a weapon to destroy economies?
No, I mean, it'll be the mechanism will be self-destruction, mainly because that $2 quadrillion derivatives market I mentioned earlier is collateralized to a substantial degree by energy resources. This is what happened when we came out of the real estate collapse of 2007 and 8. All the usual thieves and scoundrels said, well, what can we hawk now up to our eyeballs? What can be hyper leveraged so that we can create we can do the paper shuffling that makes us our money. So they gravitated toward the energy patch, and energy resources were essentially swapped into they became a more significant part of the hyper-leveraged derivatives market. So you don't need a conspiracy, really, to bring that edifice collapsing on itself. Crude will be subject to the same deflationary forces that are going to destroy real estate values and everything else.
Are they retopping the U.S. Strategic Oil Reserve that Biden released to bring down gasoline prices last year?
I haven't heard that. That's like talking about sort of old Laurel and Hardy comedies or something. Is there anybody out there who's sort of following Biden and the Strategic Oil Reserve? I'm not sure I understand the question.
Yeah.
But the reserve is not something I think about much, especially when it relates to something that Biden is quote unquote doing about it.
The latest numbers I saw, it's down 20% from what it was this time last year. So there still isn't a lot of oil sloshing around in case you need it.
Yeah, well, the way the price is broken above low 80s in crude, we were just at that point looking at $4 pump prices across the U.S. for regular gas, but I think we're definitely on our way to $5 a gallon, and who knows? I haven't lived in California in quite a while, but that's maybe $7 a gallon there, or whatever ridiculous price Californians pay for gas. Not that that has much effect on the economy. Somehow the consumer grins and bears it, even though an increase in the price of oil drives the price of virtually everything in our lives higher.
Yes, as the Trucking Association likes to say, everything in your house was in a truck at one time. And what powered that truck?
Yeah, it's true. It's true. My son was his business was for a while he drove around the country with a partner, and they picked up vintage British motorcycles, and they went all over the country, found as many as they could, and then they took them to Port of L.A., where they were shipped out to buyers in New Zealand, Japan, and Australia. But it became so expensive. You put anything in a truck, really, and if the price of fuel goes up, it really dramatically increases the price. And he's a good businessman, but he had no clue really of whether he was going to make money on some of these shipments for a while. And so just when you start adjusting the diesel price up in the $4.50 range, whatever, it goes up to $6. So it really plays havoc with the real economy.
Do you think McMansions will be coming down in price? I guess we're talking big homes.
Well, I featured that as my commentary for last week. The headline was, "Who will buy this McMansion?" And there's no way that home is going to change hands at its currently insanely inflated price. And it's a given that the buyers won't be there at those prices. So what that implies is that all of the McMansions lived in by the baby boomers currently, they're not desperate to sell. They figure they don't have to, but that's a good thing because they couldn't sell them even if they wanted. You know, there's no entry level, there's no first time buyers in there with mortgages pushing up toward 8%. So anyway, there's no one to buy those homes. Demographically, you're looking at, you look at the Gen Xers and the millennials, and they're still paying off student loans, $40,000, $50,000, $80,000 student loans. They'll never pay them off really. And it's not like the additional burden that baby boomer Social Security and Medicare will place on them will not bankrupt them anyway, never mind the student loans. So there's no money there. I mean, they're up a creek, and I think if there's sort of a generalized anger there that expresses itself politically sometimes from the millennials, it has to do with the fact that they can see it. They can say, you baby boomers, you ate our lunch and our dinner and our breakfast and everything else. There's nothing there. But there's plenty of it too, and that's debt. So they're never going to enjoy Medicare. They're never going to enjoy Social Security, and they sure as heck aren't going to be able to. Well, they will inherit the McMansions. That's what has to happen, and because they won't even be able to keep the yards mowed, there's going to be a lot of deterioration in those properties, and the tax base for all the towns in which McMansions have been built, meaning every place in America, the tax revenues will decrease, and it's going to be a big hit on the amenities of the small town amenities and big town amenities too of this country.
Interest rates, are they going to continue to rise?
Yeah, but not in the way everybody expects it. They could go down even as we experienced in 2007 and 8. They could go down and still, in real terms, be rising. It all depends on the underlying collateral. So, in the 2007 and 8 financial crash, home values they decreased by 33% on average across the USA. And so with that, at that point, even a 3 or 4% mortgage was a crushing burden. So everybody who thinks interest rates are going to keep rising, they need to consider the crucial concern that it's only the real rate that matters. So I don't think they're going to keep rising. Maybe a bit. I've got my own target in the 10-year note up around, I think it's 4.6%. No, actually, let me give you some good targets for this because this is an important number. Yeah, I could see the 10-year going, it looks like it's going up to 4.6%, currently 4.33%. If it blows through 4.6%, we're going to see 5.06. All right. And, But that would be a very important top. I think it would probably be a major top in rates. And that's plenty enough to essentially kick off a catastrophic deflation. We're already, the rates, even at the current levels, are high enough that it's putting a lot of real estate lenders in real jeopardy. And in the commercial sector, it's worse than urgent. I'm not sure if we talked about it, but there was that sale in San Francisco of a building that had been bought in 2014 for $110 million. And as of a month or so ago, it was being carried on the tax rolls at $140 million valuation. Well, somebody banged out a sale at $41 million. And what that did is it marked to market every commercial property, not just in San Francisco, but in every failing metropolis in this country, including New York City. So it's the sale from hell that nobody wanted to happen, because it's one thing, if there's almost no transactions, you can maintain the fiction that real estate values will recover. But as soon as someone whacks a $41 million bid for this 11-story office tower, it set prices at the margin. The same thing will occur in your basic San Francisco peninsula real estate. You've got a cul-de-sac with $3 million homes, right? So one of the homeowners gets on the ropes and he has to sell the place for $1.8 million. Well, every home in the cul-de-sac has been priced down to $1.8 million. So that's what's going to happen. Prices get set at the margin, and the only reason real estate prices aren't collapsing now is that because transaction volume is so low. There's really just not enough properties moving to say this is the price or that's the price. But again, when somebody comes in and hits a $41 million bid for a $140 million building, it's like a shower of cold water. That's reality.
Is AI going to be like .com was back in 2000 when it collapsed? A lot of promising companies, but only a few will survive and be profitable.
Well, here's the punchline on that $41 million sale of the building. Yeah. The owner, a very sharp looking, now you look at him and you think this is one smart guy. He's a young guy. He represents a company called Presidio Group in San Francisco. And his plan, he bought the place. He's going to put $50 million into refurbishing it. And you look at the guy and you think, this guy, he's just one of those guys, who whizzed through college and graduate school, and he's a genius. But here's what he said. He said he thinks that AI is going to bring back San Francisco. In other words, it's going to require so many genius coders that San Francisco will rebuild a population of grossly overpaid workers, and overpaid because the valuations of the stocks of the company, shares of the companies they work for, will be ridiculously pumped. So here's a true believer in AI. I'm a true total disbeliever. I look at AI and my feeling is, if it's so good, why can't you get spell check working right? Spell check is a universal joke, and that's AI. To me, that's where AI is. And if you've asked AI a question and had it type you a paragraph or two as an answer, you'll know that AI doesn't really, it's a chimpanzee. It'll give you words strung together in sentences that people can read, but it doesn't get anywhere. So I think AI is hugely overrated. Probably the person coming at it most aggressively is Elon Musk right now. And he's sinking most of it into AI as it would apply to a driverless car. So Wall Street didn't lose any time marking up the shares of Tesla, sort of jamming it up the butts of shorts on the story that if Musk sort of gets a lead there in AI that essentially comes about because of his involvement in his total obsessive commitment to driverless cars, then he's gonna have a commanding position in that field. But when you look at, Wall Street says that kind of garbage just to hype the stock. But when you look at it more closely, you discover, number one, nobody has a clue how much more data that you need to input and crunch out algorithms to make driverless cars work. They do know that they have vastly more powerful computers, a lot more computing power to essentially store data, but whether it even applies to other types of AI usage, such as, texting and things like that, verbal stuff, well, this is purely visual. It's an entirely different skill set. So when you sort of deconstruct this idea that Musk is really going to forge ahead in AI, there's the possibility that it's going to fail completely. Big players, GM sunk $5 billion into the driverless car idea, and they wrote the whole thing off. So Musk, you got to give him credit for being, he's an amazing guy, really. But so far, my question is, well, can you do a little bit better on spell check before you give us driverless cars?
Rick, can you tell us a bit about Rick's Picks and how people can sign up for it?
I'd love to. It's nice you asked. Rick's Picks is geared to traders, and we had some good ones last week. We had Apple puts using a target of 189.90. We were 2 cents off the top, and everybody, the subscribers, bought put options for as little as 6 cents a piece that went to $6.61. So they could have made as much as 100 times their money. And so we do that in the chat room. There's a lot of real-time trades put out there, and I like to think that I have some of the best traders you're going to find anywhere online in that room, and they're a pretty helpful bunch. If you want to take a free trial to Rick's Picks, just go to Ackerman.com, and up at the top of one of the tabs it says subscribe free or some such, and you can, without using a credit card, you can get a free 2-week trial, and do say hello when you come into the chat room.
Rick, thank you so much for being on This Week in Money.
I always appreciate the opportunity to connect with your vast audience there, Jim. I always enjoy chatting with you. So thank you.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from Charleston, South Carolina. Coming up, Eric Hadik, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, thanks for having me back, Jim. Great to be here.
Eric, can you tell us a little bit about InsideTrackTrading.com and why you have two eyes on the inside of Inside?
Well, when I first started it, and it's a advisory and analysis and advisory service that originally focused on the futures market, but has expanded to corresponding markets surrounding that, everything from foreign currencies, precious metals, interest rate vehicles, stock indexes. But in originally putting it together, I wanted a acronym for the major markets that were being focused on. And so that's where that extra I came from, because you had I forget the order I had, because either interest rates or inflation indexes or indexes was the IN, but then you had S for stock indexes. So that was the SI, then the inflation, then the dollar, then energy. And so it was each of those market complexes were the focus, and you had three of the I's between the interest rates, inflation markets, and the I in stock indexes. So that's where that came from, but that is still our core focus, but I do a lot of analysis on cycles and how they impact the markets and impact the world, but always taking it to a practical and more treatable level with technical indicators that I use, some of which I've developed.
And Eric, your research concentrates on the cycles you found, doesn't it?
That is really kind of the backdrop or the foundation for a lot of my analysis. I recognize that trading off of most of these cycles is not the most prudent approach. So they set the stage for me, and then it's a lot of my specific indicators that I employ to validate those cycles and to formulate related trading strategies around those cycles.
Now, stocks followed your August outlook for a quick drop, but have since diverged. Can you update your outlook and explain what this divergence could be telling us?
Well, you've seen different levels of divergence for the last 2 years in stock indexes, and what I'm referring to is have some of the key, call them stronger indexes, rallying to new highs during specific cycle peaks, and at the same time you'll have weaker indexes bouncing but setting a series of lower highs during those same cycle peaks. And same thing inversely with lows, where those weaker ones will be setting lower lows, and so over time they're making a progression of lower lows, even as some of the stronger indexes like the NASDAQ 100, S&P 500, and to a lesser extent the Dow Industrials, they'll be setting progressively higher lows in what's basically a continuing uptrend. And on a near-term basis, we've seen that again, where my work was saying that we should see an intermediate top in late July, early August, that we would enter a little bit of a danger period there in the first couple weeks of August and see some selling. You got that. You saw all the indexes pretty much in tandem selling off and bottoming right in lockstep with multi-week and multi-month cycle lows in the second half of August. But since then, you had, again, the NASDAQ 100, S&P 500, Dow Industrials. They've rallied and then just gave a moderate pullback. And at the same time, some of your smaller and mid-cap indexes, the Russell 2000, the S&P Mid-Cap 400, and even the Dow Transports, they, after that initial rebound, sold off again. Some of them making lower lows, the Russell and the mid-cap going right back to their late August lows. And so it's that continued divergence where those indexes are really, their whole pattern is indicative of a major topping phase, the way that they have been after their initial sell-off in 2022, then rebound. They've now been rolling over to the downside for several months, even as some of your other indexes are climbing, sometimes climbing a wall of worry, but still climbing. And all of my work is still telling me to look for the next important top coming in the first quarter of 2024. And ideally in January, there's even a specific week that the S&P 500 has a lot of cycles converging during, and some of the other indexes are corroborating that. But that's the time where I would expect to see those stronger indexes set final tops, and the weaker lagging indexes probably just continuing to make a series of lower highs, but probably turning some key monthly indicators down at that time frame and it'd be one of those things where finally when those weaker ones start to break some key support and turn some multi-year indicators negative, then the stronger indexes can no longer support the whole market, and you get a more significant sell-off.
Energy markets often move similar to stocks. For the past 4 months, you've forecast an oil rally into mid-September, and WTI has hit $90 for the first time since November. Now what?
Well, I do think that crude and the products, heating oil, unleaded gas, they've fulfilled most of the upside objectives that I had for this whole 3 to 4 month rally from the early May and mid-June lows. In mid-June, when crude triggered a 2 to 3 month buy signal, it just reinforced these cycles in mid to late September, when I thought we would see a peak or a culmination of that rally. There are some remaining cycles looking out in the next couple months that my determination for them is based a lot on what these markets do coming off of this mid to late September peak. So in other words, if they sell off, and one of the indicators I watch is my weekly trend indicator, if they turn that negative, then it tells me that the subsequent cycle high is going to be a lower peak. Whereas if, in contrast to that, they sell off right now and can only neutralize these indicators, then it tells me they should rally back up, retest the old highs, probably spike about above them a little. But either way, it's a time for a subsequent high, and following that, time for probably a more significant sell-off. But I do think that the energy markets are coming into an important peak, all except for natural gas, which has been going through a long bottoming phase, and is actually getting closer to the time when some of its indicators are turning positive.
How did the U.S. dollar's recent rally impact your outlook for the rest of 2023, and does the recent BRICS news make any difference?
Well, I think the BRICS news has some very longer-term implications, and I'll get back to that in a minute. But the dollar's rally has pretty powerfully confirmed the cycles that bottomed in mid-July. And it wasn't just cycles bottoming, it was a lot of price indicators that were fulfilled and turning positive. It was even some very comparative wave structures where, if you look at over the last 15 years in the dollar index, it has had 5 pretty significant declines, this most recent one being the 5th. And each one of them was roughly the same magnitude to the downside, and this latest one matched that, which is often when you'll see an initial low take place, you get that kind of decline equals decline wave comparison and wave similarity. But it's the synergy of so many things that came together in mid-July and told me to look for a pretty significant rally in the dollar leading into January of 2024. But the context of that rally is what's probably the most important, and that's that I think the dollar's initial sell-off was the first leg of a larger bear market. We filled a lot of multi-year upside targets in late 2022. For many years, I talked about the dollar rallying to one more high. It had to complete a 5th wave from its 2008 bottom. So if you look at the longer-term charts, you can kind of make out a clear rally, pullback, and then a final rally. So 5 waves creating or fulfilling an overall uptrend. And the targets for that top were up at 110 to 113 in the dollar index, which is exactly where it reached and peaked in late 2022. So there's some pretty serious reasons to expect that the dollar has set a multi-year top and is in a slow process of entering a bear market. So this rally that I'm looking for into January, I think, is your 2 wave or your B wave You have your initial decline, which, depending on the overall structure of the wave, is either labeled as a 1 or an A, and then your subsequent rally is a 2 or a B. It really doesn't matter a whole lot in the immediate sense of things, which you label it, but in either case, you get a pretty significant rally. But I think after January is when the dollar's going to start running into new headwinds and start showing more convincingly that a top is intact. And I've talked about this from even a really broad generational standpoint when I've talked about the 40-year cycle that I follow pretty closely, and one aspect of that I called the 40-year cycle of currency war. And what I detailed throughout the 2010s was that we were coming into the culmination of the latest 40-year cycle, and I thought that from 2016 to 2021, you'd see gold see a strong rally, and that was kind of a precursor to some of the things I expected once we entered a new 40-year cycle in 2022. And I think there's a lot of aspects to that people don't recognize yet, or maybe they just kind of have a very slight awareness of, but not the real implications of it. But getting back to the latest BRICS summit, I think that their announcement was certainly profound, and it really just reinforces what's been going on there. So, you have those 5 countries, Brazil, Russia, India, China, and South Africa, making up that acronym of BRICS. And they've been, coordinating things for the last 12, 13, 14 years. And a lot of that is a reaction to the power of the dollar and the IMF and the euro to provide a competing monetary and economic union. And with this latest summit an annual summit they came out afterwards and announced that they had extended invitations to 6 new countries, Saudi Arabia being one of them, to join their BRICS union. And at the same time, you keep getting talk of trying to stop using the U.S. dollar for all of this global trade, including, and foremost among them, the oil trade. And, when you go back to the history of what has kind of supported the dollar since the mid-1970s, it's been that understanding between OPEC and the U.S. that oil would be priced in dollars, and then some of those nations would buy treasuries with some of the dollars they brought in, and that would support the U.S. debt, and just a whole symbiotic situation there that is very slowly starting to unwind. And, a lot of times you get many of these steps that are kind of subtle, and everyone says, oh, it could never happen. There's this reason and that reason why, no one would ever abandon the dollar as the global kingpin. And that may even be the case, but what if 10 or 20% of that trade shifted? That's big ramifications, big reverberations would come from that. So even though the theoretical argument that, the dollar will still remain as the world's reserve currency, maybe it will for a time, but as others start to rise in their own significance, that has a serious impact on particularly how traders perceive the dollar. And that's what governs the market. It's perception as much as reality. The reality is often only a small part of the equation, but I think over the coming years you're going to see more news, more communiques, more movement forward in this type of shift, and it's going to start to undermine the dollar.
The BRICS discussed developing or releasing a gold-backed currency. It didn't happen at their meeting. Do you think they eventually will?
Well, that's something, too, that has been floated a number of times, and not just with BRICS. And, you know, I don't know whether that will ultimately be the case. It's certainly, even if it was a partial backing, that would be something that, again, from a perception and a proportional basis, even just something that's a small percentage backed by gold would have an oversized impact on the markets. And so I don't know if that's going to be the case, but like you said, they do keep floating that. And when you look at the last 10, 12 years, and my last several Inside Track newsletters, I've started to re-delve into this whole series of events and some of the ramifications of it. But you've seen, when you look at the list of the top 10 buyers of gold over the last decade or two, and Russia and China have certainly been up there, and of course it's been European nations doing the selling. There again, it's one of those steady, subtle shifts that mean nothing until all of a sudden they mean everything. And you see that in so many things in the market, that the market kind of sweeps something under the rug multiple times, and then all of a sudden it's often just a tiny additional event or news item. It's like the proverbial straw that breaks the camel's back. You know, you keep putting each straw on, and it's like, okay, it's not doing anything, and then all of a sudden it just takes one more. And that's the type of shift that I'm starting to look at, looking out over the coming years. And there's a couple time frames in the next 5-year period when I think you have a much greater probability for some of those more significant events happening and impacting everything from gold to the dollar and many other foreign currencies as well.
Do you follow the Chinese yuan? If so, how does that play into the whole mix?
I do follow it kind of from a secondary basis. It's not one of my primary currencies that I do weekly and intra-week updates on, but in my monthly newsletter, I have been, and I've actually started to increase my focus on it this year, as I've been thinking and saying that I thought the yuan would head lower into the end of 2023, early 2024, but it's at that point where there are some major multi-year cycles, either in the yuan or in related markets, that tell me it should put in a pretty significant bottom. And that may be one of those results or consequences of China and some of these nations starting to move more towards gold backing of currency or a partial backing. And you even, when you talk about these kind of steady, subtle things happening, you go back to, I believe it was 2016, when you had the launching of the Shanghai Gold Fix, where all of a sudden now China was getting involved and playing with the big boys on setting the daily price of gold and trading, have an exchange for gold. And I detailed over the last 10 years the sequence of major ducks that China was lining up in a row and saying how I did not think you'd see anything dramatic until they had all of these things set up and running, and starting to influence others to shift their focus. And I think that that's what we're seeing, that when people look back, they're going to look at this time frame, 2022, 2023. It's going to be so easy to see that this was another shift of this 40-year cycle, and they'll see that this is when the whole mindset began to slowly shift. but it's when it starts to accelerate when you really see some dramatic things in the markets.
Do you think the yuan has a chance to be the world reserve currency?
I don't know that that's the case, and I think that China's economy and everything else, the way they structure it, even the currently the whole real estate struggles that they have, and that much of which the stuff still hasn't hit the fan. I think if it were to be, it would be a long way off. And so at any time on the foreseeable horizon, I don't think so.
What effect could topping interest rates have on the markets, and what do you expect for rates over the next year?
I'm still very closely following, adhering to, and writing about and anticipating this uncanny 4-year cycle that you have in the bond market, and so inversely in interest rates, that has just been so precise in timing the major turning points going back to the 1990s. But I wrote about this back in 2019, 2020, when I thought bonds were getting ready for a multi-year, probably multi-decade top in mid-2020, and related to that, a multi-year bottom in the corresponding interest rates. But July 2020 was exactly 4 years from the previous peak in bonds in July of 2016. That was 4 years from the prior peak in bonds in July of 2012. And along with my cycle progression evolution, you could take that back and see how it impacted interest rates every 4 years, like this sine wave sequence that I describe in my cycle progression. But the bottom line is that as the July 2020 peak was forming and was being validated in bonds and corresponding interest rates were bottoming, I described the scenario that a normal 4-year cycle would take from that point within a trend, a higher high during the latest cycle and the culmination of a long-term wave. In a kind of textbook scenario, what you would see, and what I wrote about in 2020, was that I thought bonds would see a 2.25 to 2.5 year decline, and then about a 6 to 9 month bottoming phase, and then, depending on what was left in that 4-year cycle, a 6 month or so rebound into July 2024, which would be the next phase of that 4-year cycle. Well, bonds did exactly that. They sold off sharply into October of 2022, 2.25 years from their peak, and interest rates have continued to climb since that bottom in bonds, but bonds have been in a bottoming phase ever since. So you've had this kind of consolidation phase near the lows in bonds for 9-10 months now. And I think we're getting close to the time where you'll now see this 6+ month rally in bonds. And so interest rates at some point in there would likely decline. But as I keep stressing, it has as much to do with perception as anything. Interest rates continued to rise since October of 2022 until just recently, but bonds didn't continue to sell off. That's because the perception, the anticipation had already been built into the sell-off in bonds. So when they sold off into late 2022, they were already discounting several more interest rate hikes. So when you're trying to trade a market just based on news and saying, oh, rates are going to keep going up, Fed says so bonds should keep going down, that's already been factored in. The bond traders are saying, what's next? What's going to happen 6 months from now, not what's going to happen tomorrow. And so that's why you've seen the market kind of flatline for almost getting close to a year now, and bonds and notes have just gone back and retested the lows on a continuous contract basis from late 2022. And so that's kind of the another confirmation that they're in this bottoming zone. And I think that the expectation that interest rates have peaked and will eventually start to taper off a bit. That will drive bonds higher. If we, once we get into early 2024, that could be one of the things that helps set a secondary top in the dollar. That once you get the perception that rates are going to head a bit lower, now all of a sudden the dollar doesn't have as much appeal. And so there's a lot of ramifications to that. And that's also this time frame when I think we could see the next big move up in gold and silver, because as I've described it as kind of a sweet spot for inflationary metals, that you still have inflation in the markets, in the economy. In fact, yesterday and today's U.S. CPI and PPI numbers both came in a little hotter, a little higher than expected, much of that due to the oil price rise in the last few months. But so that inflation is still there, which in certain conditions is bullish for gold and silver, but only in certain conditions. And up until now, that inflationary fears created the expectation for higher interest rates, which is bad for gold and silver. So that's what's kind of kept them under the thumb. But now you get into this phase of an inflationary and an interest rate cycle where the expectations are that, okay, interest rates have probably peaked. So that starts to put a bottom under gold and silver. But you still have these inflationary factors in the market, and that starts to become a little more of the focus, that now it becomes a supporting factor in some of those precious metals. And I think that we're going to see a late 2023 and out through a chunk of 2024 rally in gold and silver, and even some recovery and rallies in metals like palladium and platinum.
Eric, where can listeners get more information on Inside Track and the Weekly Relay?
Best place to find out anything is at our primary website, InsideTrackTrading.com, and that is inside spelled with that extra I in the middle, so it's INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thank you for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from Central California. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, and Eric Hadik. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@HoweStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.